Better luck next time, sport.
For years I've been racing that title.
In trading Forex, in trading commodities.
And somehow, he always wins.
Hi everybody. Today I'm going to show you my turtle strategy that has allowed me to double my account in around a year. I started with around 400 bucks and now I am at 1,250, as you can see from here. First of all, I would like to show you my results. To do this, I will use an instrument called Training Performance that is available on my FX Trade Owanda platform. Owanda is my broker and FX Trade is their live platform. If you want to see a review of this broker, there is one available on my channel, so you might want to check it out. So here is my trading performance. I have a 94.6% win rate. Here you can see my total profit. Here you can see my portfolio breakdown. I generally trade Brent crude oil. I used to trade gold, but I don't now because it's too expensive. And I trade two Forex pairs at the moment, the Euro US dollar and the GDP US dollar. Here you can see an official statement from my broker. For the month of March, I made a pretty good profit of 118 euros, which is a pretty decent percentage when you think about it. Please feel free to pause and study this account statement. I'm trying to be as transparent as possible with you. Keep in mind that the leverage here is not 100 to 1, it's more like 30 to 1. If you have any questions, feel free to ask me in the comment section below. So now, let's move on to my trading strategy. The first thing to do is to first select the instrument of your interest. This strategy works for every kind of instrument. And you select the 1-day time frame. The only thing that you need to focus on is the price, nothing else. Forget about indicators, they will come into play later. You shouldn't focus only on indicators. Indicators work until they don't. So be very careful about the indicators that you choose. For me, the price is the best indicator. I believe that the price of every single instrument moves into quarters. There are big quarters and there are small quarters. A big quarter is a 250 pip price movement, and a small quarter is only a 25 pip price movement. So for instance, let's take the $60 level of the Brent crude oil. Suppose the price moved by 250 pips. That will bring us to $62.5. So that is a big quarter movement, and I call the $60 level and the $62.5 level a major quarter point. Let's say that the market is bearish and the price is falling. If the current price is $60, the next big quarter point would be 57.5, and so on and so forth. These large quarter points are considered by me as support and resistance levels. See what happened right here? The price was in a bullish trend and it touched the $60 level and it broke it and it tested the $62.5 level. Now, as you can see, the price didn't exactly touch this level, but if the price comes within a small quarter point or 25 pips distance of the big quarter point, you should consider that the quarter point level is reached and you should immediately take profit. What happened next? The price fell. The price fell back to the $60 level. However, the momentum wasn't big enough to test the next big quarter level of 57.5. And again, the price went back up to the 62.5 level. Again, not enough momentum, and the price retraced back to the $60 level. Same thing happened. No momentum, no downward momentum, and the price went back up again. Here the price fell a little bit, but it didn't actually hit the 160 level. The distance between the lowest point and the next big quarter level was more than 25 pips. And this time the price broke the 62.5 level and it tested the next target of $65. Now let's go back even further. Here you see a high level and a low level. How much you're willing to bet that those levels are big quarter points? Well, let's see. This level is 87.3, which is very close to a large quarter point. How about this low? This low is $50. This is exactly a large quarter point. When you study the price around those levels, you can predict where the price will go next. Of course, you can't be 100% right every time. Let's take an example here. I sold 10 units of Brent crude oil at $70 because I was thinking that the price won't continue going up. Why I thought that? Because the price hit $70. However, over the course of 3 days, it failed to reach the next big quarter level of 72.5. I still think I still have an overall bearish sentiment because as you can see, the price failed to reach the 72.5 level for more than 3 days. So if a price doesn't reach a large quarter point for more than 3 days, that means that the trend is weakening and it's probably reversing. You will eventually make a mistake, like I did right here. This is where the essential part of my trading strategy comes in. You should always make multiple small positions every time. In that way, even if you make one mistake, you can add up to your position and eventually the price will go in your direction and you will be able to make profit out of it. That is why I have a very high winning percentage because I never close my positions. I just wait. I remain flexible because I can still make positions. Most people risk 40% of their capital or something. That is a huge risk and this can blow up their account. In general, I never surpass 10%. I can go to about 15%, but not more. This indicator represents the available margin and the taken margin. You need this number to be no more than 15%. It's more than 15%, that means that you're becoming too greedy and you can potentially lose your money if you're too greedy. I sometimes look the MACD just to confirm my entry. As you can see here, the MACD is kind of curving and I believe it's going in bearish territory. So probably when I see a bearish cross, when I see a MACD bearish cross, I will sell another 10 units and my average price will be roughly $71. So if the price falls below this level, I will be in profit. I wish you happy trading, and I'll see you in my next videos.